Hello, class, and welcome to our third lecture series on principles of accounting or financial accounting. And I'm your instructor, Jamal. So today we are starting a new chapter, transaction analysis. But before going into our next chapter, we have a question from our participants that what is the difference between account payable and notes payable? So both are under liability, right? So the difference between account payable and notes payable is that in accounts payable, mostly it's a word of mouth. Okay, I have to pay you, or there are some agreement that is signed from the vendor or from the suppliers. Okay, I'll pay you after 30 days, after 15 days, after 10 days, after 2 days, or after 1 day, after an hour or whatsoever. But in notes payable, the company will sign on its letterpad or on a printed form or something under the company name that I will pay you this much amount after this much time. For example, if I'm a supplier, I supply goods to a company XYZ, and I supplied the goods worth of $1 million. But the company says, XYZ says, I would give you back this amount after 6 months. I can say to my XYZ company, my money would be blocked with you for 6 months. Hadn't I received my money, I would be, simply saving it with the bank and would be earning 5% interest. So I would be losing my money. The cost of the money is going to be for 6 months. So my business is going to be hard. My money is locked. So you should compensate me for the period. I'm a supplier. I'm not giving you the loan. I'm giving you the goods, and you will sell it or convert into finished goods and then sell it. But company says that we are going to pay you after 6 months, so it's okay. We understand that your money was going to be blocked for 5 months, so they would be making on letterhead the company name, and they say we will pay you 1 million with 5% interest, and total amount going to be there. So after 6 months, you present that letterhead or their format or something to the company, and company going to give you not only 1 million on the top of 5% as well. So normally this is called notes payable. So company are giving you on their notes, on their letterhead, on the company's name, they're going to make you sure that, okay, we have your money and it is logged and it is for 5% interest. Sometime the supplier, like I said, I require no interest. I would say that you can give me, 1 million on step-by-step process. Okay, on 1 month you will give me, next month you will give me 200,000. Month 2 you will give me 200,000. Month 3 you will give me 400,000, and then you can just give me 100,000. That's my balance is off. Maybe you can say that there is no interest because on the day-to-day basis, business has a relationship with the partners. So if you ask, sometimes the supplier, they say that we are not charging you interest because it's going to cost us our relationship. So, but you're going to give me, well, I understand that you cannot give me 1 million at once, but you can just pay me on step-by-step process. So all these terms and conditions are written on the notes payable. Right? So any more question regarding accounts payable and notes payable? Pino, Anthony?
Very clear.
Good. Okay, so let's go towards our current lecture. Here we go. So our first learning objective is explain what a transaction is. So we are heading towards now fully understanding the development of accounting system. Right now, what we have studied in our previous two lectures, just the basics. What is the definition of, what is the equation for income statement? What is the equation of balance sheet? What is the equation of retained earnings statement, right? What are the purpose of these statements? What are the hierarchy of these, these financial statements? And now we will try to see that how actually transaction go through these statements. Okay, so first of all, what is transaction? So any impact that has any event that has financial impact on the business. So remember, all the barter systems are not called transactions, right? Free resources are not the transaction, must be having some financial. Even a barter system, if it is having a financial impact on the company, we will record it, right? So it means free services are not included in the business or in the transactions, right? Second, it can be measured reliably. What does it mean? It means you can measure it in some currency, authentic currency, right? It's not like that. This is the company XYZ, and this is the company ABC. XYZ sells good to ABC, and their original price was, for example, they sold the goods for $1 million. Since the ABC company is basically is managed by the wife of the CEO, and they just say that, okay, since I need to increase the sales, so we know that this is $1 million worth of goods, so but you will give me $1 million, but I will record it for 2 million. So you inflate, you increase the prices unrealistically. So that's why it's measured reliably. It means if you sell the same amount of goods to some other companies, MNO companies, so it's the same worth of 1 million, not the 2 million. Okay, plus currency would be the same. You don't say that $1 million or 1 million yuan or 1 million peso or 1 million rubles, lira, whatsoever, we don't know. Swiss franc, right? So that's why it should be measured reliably. Plus, transaction always have two sides. One is giving side, one is receiving side. If the sale occurred, company give goods and receive money. Let me clear this mess here so that it's more meaningful. Right? A transaction must have two sides, at least two sides. On the one side, there is a give, and on the other side, there is a receive. Right? And remember, accounting records both sides. Right? How? We will look in our coming slides. There we go. So the example of transactions are, for example, you purchase fresh produce food, and company sells the product, borrows the money, repay the loan. So there is a give and take, right? When you purchase, food is given to you, company receives the money. If you borrow the money, company receives the money, right? Company increases their liability, record the loan. And then when payback, cash is going out, giving side, right? And what on the liability side, our liability also decreases, right? So there is also a two-way process, right? Now, our second learning objective is define account and list and differentiate between different types of accounts. So like we, talk about in our previous class, there are different classes of the assets, current assets, long-term assets. And under current asset, there are different accounts, cash equivalents, and then short-term investments, inventory, it's like that. So these are called accounts. So let's just talk about that. So we know that the accounting equation is assets is equal to liabilities plus owner's equity. So account is, it record all the changes in a particular asset, liability, and owner's equity. So basically it is a summary of what's going on. If a cash, so it means all the cash details going to be included in cash account. So all the, you can say that. So I was talking about the cash. So all the cash transaction that is hitting the cash would be recording in the cash. So cash account summarizes all the cash transactions. Land, any transaction that involves land would be written under land. So it also becomes a summary device as well, right? So you have a bigger head which is assets. Under assets there are current assets and long-term assets, and under current assets there are different accounts: cash, short-term investments, account receivable, inventory, like that, right? Under long-term assets, plant, machinery, vehicles, and intangible assets, and all those others, right? Here we go. So what are the assets? We already talked about that in our previous lecture, so I'm just going to go through that. So here we go. Cash means anything that is close to money, which means if you present something and bank accept that on the spot and give you the money, this is called cash. Whether it is in the form of certificates, it's in the form of currency, it is in the form of coins, that includes all the cash, right? Account receivable, what did I say about account receivable? Account receivables are customers, which means a promised future collection. So normally they are customers. And which kind of customers? Not those customers who are giving you cash at right now. No, those customers who took your goods and say that we will give you your money later, right? So it means these are the one to whom we have our credit sales or sales on account. Sales on account. Which means we sell the goods has been delivered, money is not received right now, money will be received after later sometime, right? The third one is notes payable. Here we go, the notes payable. It is also future collection, but remember, customers sign the notes and there is going to be interest rate, like notes payable. Similarly, it is notes receivable. So in notes receivable case, the company can say that, look, we sell you the goods for $1 million, right? But you are going to pay us after 3 months. Our money is going to be blocked for 3 months. So we will be charging from you 3% interest, right? So customer signed it on their letter or on their stamp or some whatsoever legal documents, and company has those documents, and when customer after 3 months come, so they present